Hello everybody, and thank you for attending our new webinar on Brexit, now that we stand 1 year after the pro-Brexit vote. During the presentation, we'll see together what the difference a year makes for the UK households, but also for the companies. And we'll also touch upon the medium-term scenarios in terms of EU exit or the next trade relationship with the EU or other countries in the world. I will take the questions at the end of the webinar, but please don't hesitate to already submit them during the webinar using the Q&A widget. I will try to answer as many as I can during the webinar, but if we lack time, I will come back to you by email as soon as possible. So Brexit 1 year after, what can we say? Well, overall, there was economic resilience. GDP growth stood at 1.8% last year, which is relatively high when we look at the Eurozone average, for example, which stood below. But still, there was a slowdown compared to the year before, where growth stood above 2%. And there were already signs over the past months of the year that there is a more pronounced economic slowdown that will start to be more visible at the beginning of this year. And there were several factors of resilience, and we have pointed out 6 here. But what we can say is that over the past months, and more importantly, since the Article 50 has been triggered at the end of March, there are 3 out of these 6 important resilience factors there that seem to be more endangered. And we have here, obviously, the political uncertainty and the fact that with the minor government, the minor majority that we have today, there are still downside risks to the political environment and the political stability. Although we don't expect new elections to be organized in the next 12 months, because we all know that the process is very heavy and the time period is very short. The monetary policy that has been very proactive last year has more limited room for maneuver for this year, given the sterling depreciation and the fact that the households have been very much impacted by that, plus the housing market, which could become a risk given the fact that prices are starting to slow down quite rapidly. So we expect a possible rate hike by year-end of 25 basis points, which will have as a main purpose to stabilize the sterling. So it will not be a sustained and tough tightening program, but it will more be a progressive and targeted monetary policy tightening or normalization. And the third factor are the consumers that have saved the day last year and that now are losing purchasing power quite rapidly, and we don't see any upside risk coming further. In our view, the sterling has been the first variable to be impacted. And it was the most impacted when we look at other indicators. Well, it lost 9% since May 2016 on a real effective exchange basis. But when we compare it to the euro or to the dollar, it lost around 12 to 13%. So the depreciation was strong, and it had a significant drag. It has been a significant drag on households' purchasing power. And we'll see later on that also on the company side, there are negative repercussions. If we look at the chart on your left, you will see that there was a strong depreciation in the sterling that drove up the consumer price index. Inflation went up to 2.9% year-on-year in May 2017, and it will most surely go above 3% during this summer. And when we compare it to the pre-Brexit vote period, it stood at 0.3% year-on-year. I agree that part of this increase is also due to the fact that there is a reflationary global trend and a rise in commodity prices, but most of it comes from the sterling depreciation. And the first negative impact is on the real wages for households. They are contracting since February 2017, as you can see on your right, and they stood at minus 0.2% year-on-year in March 2017. So last year they were increasing at 1.7% in real terms, because, as I said, inflation was close to zero, and nominal wages were rising around 2%. Well, now there is a trend, there is a possible trend of rising wages in the future because there were already visible tensions on the labor market. The fact that there are rising unfilled jobs on the UK market, it shows that the supply is tight and companies have difficulties to find the right skilled person in some sectors. Sectors like construction, for example, but also sectors like engineering and other type of services. In addition to this drag on households' purchasing power from the high inflation, but also from the slowdown of nominal wages, as we have seen on the previous slide, we think that the buffers that the households have in order to consume more, or at least to keep a stable pace of consumption going forward, are much more limited than before. And we have on the left the savings rate of the households in the UK, where we can see that there was a significant drop since the Brexit vote. It had reached 3.3% of the gross disposable income, which is impressive because it is not only a strong adjustment, downside adjustment, but also the lowest level in more than 50 years. So it means that part of the strong consumption and the resilience that we have seen in 2016 was coming from the saving rate and the fact that the consumers were relatively confident enough to keep the pace of their consumption by using part of their savings. And as you can see on your right, the consumer confidence indicator is basically deteriorating, but several indicators are deteriorating when we look at the economic situation in the next 12 months or their assessment of future major purchases. They are both deteriorating over the past months. So the first two sectors to suffer from this loss in the real purchasing power of the households are the retail sector and the residential household sector. On the retail side, we can see that retail sales have been significantly slowing down over the past 2 quarters. So in Q1 2017, growth stood at 2.1% against almost 5% prior to the vote. So basically what we see is that not only in nominal but also in real terms, retail sales are slowing down. Now, in terms of consumer spending, we have seen also a slowdown in Q1, and this slowdown in demand for the sector is coupled with the fact that the sector is already suffering from a high indebtedness and a low profitability, which adds to a very tough environment where competition remains very tight. On the residential housing sector, we see that there was a fall in demand when looking at the mortgage approvals. They have been falling for the 5 last months. So they fell by 3%. They reached a little bit more than 64,000. Well, it is in our view a sign that the households are less keen to take loans in order to buy houses, because we also see a slowdown in house prices. On your right, basically prices have increased at their slowest pace since 2013. So in May we had an increase of 2.1% year-on-year for house prices against 4.7% in May 2016. If we now look at the companies, we can see that the higher uncertainty had triggered a wait-and-see attitude from foreign investors. And we all know that the UK was one of the very interesting and attractive European markets when it comes to foreign investment. We have taken here the mergers and acquisitions cross-border deals, because we think that it is an advanced indicator which shows us the attractiveness of the UK still, and could give us an indication of a potential loss of appetite for the UK market. And what we can see is that since May 2016, the total cross-border value of completed deals has fallen by 35%. So it is the chart on your left and basically the blue curve. So we have seen that the total value has fallen quite drastically, while the total number of the deals has increased by 6%. So this shows us that the activity, the market remained dynamic, but the big deals have not been completed anymore. Because we can see that on the right, the pending deals have increased quite drastically since the vote, the yellow curve, plus 73%. So it means that there is this wait-and-see attitude, especially when it comes to the big deals from foreign investors in the UK market. On the payment behavior side, we see also a worsening trend over the past 2 quarters. Basically, we measure here the business insolvencies trends, and we see that they stand at plus 3.6% year-on-year in Q1. So it means that over the past quarters, we had a rise in business insolvencies. And we see that the trend started to be less favorable since the Brexit vote, the chart on your left. And overall, we expect them to increase by 5% in 2017 on average, and by 6% in 2018. While the drivers behind this increase are the obviously expected slowdown in GDP growth, which means that there will be less demand on the domestic market, but also rising pressures on margins given the sterling depreciation and the fact that the UK companies remain very dependent on imports in order to finalize their production cycle, in a context where companies in the UK continue to be highly in debt. When we look at the turnover growth in the UK, we see that there has been a strong acceleration since the Brexit vote, which in theory should be seen as a good news because it means that companies have been able to price higher their products. But actually behind that, there is an artificial price boost that we see as temporary, because obviously higher prices will induce lower volumes at one point. And if you look at the chart on your right, you can see that the profitability indicators remain on the downside. We look here at the selling minus the input prices, where there is still a negative balance in the manufacturing PMI survey, which means that, for example, in the month of May, the input prices have still been higher than the selling prices. You have here the trend, so you see that the trend is less negative than it was very close to the vote, for example, or at the peak in end of 2016. But still, the balance is negative, which means that the company's profitability is endangered. And we think that the trend on the turnovers should worsen going forward with the lower volumes, but also with the continued rise in prices, because companies cannot afford to lose profitability too long. So let's now have a look at the medium-term expected path to Brexit. Basically, well, now we have the plans of the UK government revealed. We had the Article 50 that has been triggered, and we have the new government and the official launch of the 2-year negotiating period on the 19th of June. But what will come next? Basically, what we say is that during this 2-year period, which now is much less than 2 years, and anyway in practice is not 2 years long, because we need at least 6 months in order to ratify the EU exit agreement on the European side, but also on the UK side. Well, during this negotiation period, there are several things that need to be negotiating. And this is what makes the process difficult, because they need to negotiate the EU withdrawal, they need to negotiate the WTO membership, because today they are part of the WTO through the European Union, and they also need to negotiate trade partnerships with the European Union, but also with the other countries with whom the European Union has a free trade agreement. So there are around 50 or more. And obviously the UK would want to benefit still from advantageous trade conditions, at least with part of these countries, because as you see, there are more than 50, so negotiations will be long. In mid-2019, we expect the EU withdrawal agreement to have been ratified, so ratified by the Europeans, but also by the UK. And we expect the UK to have a new WTO status. We think that the WTO status will be similar or the same with what the European Union would have today. This is the wish of the UK, and probably nobody would withstand this. But in 2019, there needs to be a conclusion on the free trade agreements with the European Union and with other states. So as we have seen in the press, the UK and official statements by the UK government, the UK wants to conduct parallel negotiations for the EU withdrawal agreement, but also for the trade agreement with the EU. We think that this is very, very difficult to do. The Europeans said that first they want to have an agreement on the EU withdrawal and then to negotiate the trade agreement. So most probably the negotiations on the trade agreement will start in 2018, but given the short time period, we think that there will be a need to have a period of transition where they will continue to negotiate the setup of this new trade agreement. If they don't manage to have this transition period, well, the worst case scenario would come in, which is the UK exiting the EU with the WTO status, which means that the tariffs that they will have to basically have on their exports to the European Union, so basically tariffs that the European Union would apply on their imports from the UK, will be high. On the other countries, we think that there will be some agreements that will be close to finalization or in an advanced stage with countries that have the priority from the UK side, so countries like Australia, New Zealand, India, United States, probably China, Brazil, and the Gulf states. But again, it will take time to finalize and to ratify all these agreements. So what we say is that by 2021 at the earliest, the UK will continue to negotiate intensively these free trade agreements, and by 2021 they will continue to be, technically speaking, part of the European Union when it comes to the rules that apply to the goods and services exchanges. Obviously, 2021 is a little bit optimistic, because if we look at the past experiences, free trade agreements take on average between, let's say, 5 and 8 years, if we look at Switzerland, if we look at Canada. But we can also say that the UK was fully integrated with the European Union, so most probably to disintegrate will take less. So 4 to 5 years seems relatively realistic, but still optimistic. So what type of trade agreement with the European Union seems realistic in our view? Well, we have three main scenarios, and the one that is our baseline is the limited free trade agreement, the middle scenario. Basically, in this scenario, we say that there will be selected sectors that will be duty-free and others that will be subject to tariffs. On average, the tariffs would reach 2 to 3% on the goods, and on the services side, there will be the equivalent of additional cost of 10% on average. In this scenario, growth will remain resilient because we will avoid recession, and GDP growth will be at around 0.3% in 2021. And as I said, with this transition period in place, because this limited free trade agreement will not be effective before 2021, we can expect growth close but below 1% in 2019 and 2020. If there is no transition deal, or if there is a transition deal, but in the end there is no free trade agreement and we go into the WTO scenario, the last one, the most favored nation principles will apply. And it means that tariffs will be at least 5% on average. But there will be sectors like agri-food, beverages, sectors where tariffs could reach more than 40 to 50%. So there is a very high divergence among the sectors that will be the most impacted. And on the services side, the additional cost could reach 20 to 30%. So in this scenario, we expect recession to start in the year of the shock, 2019 or 2021, and to be above -1% in the year of the shock. Obviously, the export losses for the UK exporters will be much higher in this scenario than in the limited free trade agreement, where tariffs will be relatively easier to handle. So we are now at the end of our webinar. The time for questions has come. If you didn't submit yet your questions on the platform, please don't hesitate to do it using the Q&A widget. And I will take very soon the first question. But thank you for already attending the first 20 minutes of our webinar. So the first question is about the construction sector. So the first question is about the construction sector and about the fact that, well, about 7 years ago, the construction and the civil engineering sectors have been submitted to the building standards and the regulations from the European Union. Out of the domestic building standards. And the question is around, do we know if there will be any sector turmoil due to Brexit, any changes in the regulation? Well, it's very difficult to say at this stage what will happen, but most probably, given the statements that have been made by the UK government of a very smooth transition, notably in terms of regulations and the legal environment, that the building standards and regulations could stay as they are, so basically following still the European standards, at least in the short term. Then, well, there is the question of the security and the recent events that could sharpen the focus in this area. So basically to be a sort of lobby to maintain the EU standards as they are, as a minimum, let's say, for the foreseeable future. Other issues that could come in the sector, as we discussed during the webinar, is the fact that there is a potential for lower demand going forward. So in the residential sector, but also in the office sector. So basically the building sectors. Then there is all the parts of the civil engineering and the public infrastructure projects where we believe that there will still be a positive momentum, because the government has announced this national infrastructure plan, and they announced that they want to keep it. So projects that have been announced, already launched, or are to be launched, they will still continue to be maintained in the future. So on the public engineering side, the momentum should continue to be good, but on the private side, given the slowdown in the economy, the loss of purchasing power for households, the momentum should be worsened. The second question is about the sectors that are expected to be impacted by a no-deal scenario, and about the probability to have some sectors that are rewarded by a no-deal scenario. Well, it's difficult to say that there will be sectors that will be rewarded by a no-deal scenario. We saw that this is the worst-case scenario in our view. We give it 20% of probability, and we think that it's more probable to have it in 2019 than in 2021. Because it could come with the fact that they don't agree on a transition period. If they agree on a transition period, as it is the case on our baselines, in our baseline scenario, well, we don't really see the point to arrive at a no-deal situation in 2021, because we assume that there is a certain situation and a certain environment that is favorable for a deal that would be securitized in the short term or more in the medium term. But let's say that we are in this scenario. Well, the rewards could go to probably, well, there could be a rise in activity for legal activities, basically consulting activities, but it's difficult to say, but probably, because there will be a rise in disinvestment. There will be a rise in companies that want to secure their access to the European Union and that were most sure that they will still have it once the negotiations are over. So these companies could accelerate their moves out of the UK in favor of another European market. And in this case, they could need some consulting activities. But the majority of the sectors will suffer, not only because there will be a strong divestment from companies that are already in the UK, but also from the fact that the conditions will change, and quite drastically and brutally, without any cushion, without any probably adaptation period. And the tariffs that these companies will have to accept when they export to the EU will be relatively high, as we saw already during the webinar. The next question is about the political environment. It's true that we were discussing last time the snap elections. It happened. Now the question is how much this government will last, and will Theresa May continue to be the Prime Minister or not? So it's basically our political scenario, if I can say so. It's how long Theresa May will be in the office, and is there the probability of a next election? Well, as I said earlier, we don't expect it to come in the next 12 months because the time period is very short. They have until mid-2018. In practice, they have until mid-2018 to negotiate the EU exit agreement. And as I said, they want also parallel negotiations on the trade deal. So they cannot afford to lose time with another round of elections, so probably another at least 1 month of blockage. Then it's difficult to say if it will be Theresa May still or somebody else. But in any case, there will be a prime minister that will be going to the European Union for negotiations. Now it's important to know which one, because the stance on the Brexit could change. But overall, what we see is that the most important is the majority of the government and not necessarily the prime minister. And we see now with this, let's say, relatively soft majority, that there is a probability to have a change in the stance of the hard Brexit. So we will need to have more compromise. We will need to have a view on the Brexit that should be business-oriented and a little bit less hard than it used to seem to be until now. The next question is about the trade agreement on services and how likely it is. Well, as discussed on the last slide, well, there will be additional costs in any case, if there will be a free trade agreement or not. Obviously, if there will be no free trade agreement, the costs will be much higher. And we saw that the cost could be up to 30%. These costs come from financial fees, from non-tariff barriers, additional regulations, changes in the way that the services are conducted in the UK market. So it's a little bit different from the goods because there will be no tariffs per se. But in the baseline scenario, we say that there will be around 10%, which is not that much for the services, but it is enough to have relatively significant losses. So we expect 14 billion sterling of loss in services exports in our baseline scenario, which are mainly coming from this additional cost of 10%, which come from the non-tariff barriers. But we say that in the baseline scenario, services, and especially on financial services, there will be a sort of compromise. There will be certainly not the passporting right still, but there will be an equivalence, let's say an equivalent status that will still allow some of the EU activities to happen in the UK. And anyway, the change will be progressive. The next question is about the debt level that has been seen on credit card spending. It's true that it is actually a new measure for consumer spending. It is a new measure for households' purchasing power and their future consumer spending. And we have seen that the indicators have deteriorated over the past months. And this is something that it was expected, as we discussed in previous webinars. Inflation is high. Wages are slowing down. The housing market is not in its best shape. The stock markets are rising, so we can say that overall wealth effects are not that negative, but still households are in a less good shape than they were before. And as we saw, the savings rate reached a very, very low level. So it's true that there is a potential to see increasing consumption on debt going forward. But in my view, it's more about the adjustment in the consumer spending than continuing to consume at the same pace using debt instruments. Anyway, households are already very highly in debt, so I don't see much leeway for them to be that confident in order to take more debt. So it will be more slowing down in the pace of the consumer spending, so adjusting downwards. Next question is about the wage growth. What could be the, let's say, the potential for having higher wage growth in a context where companies will be less profitable and there will be higher costs when companies want to export to the European Union or other countries with whom the European Union has a free trade agreement. Well, it's true that, as I said, the potential for higher wage growth is limited. There is a potential still because with the expected changes in the immigration policy, companies are afraid to really hire people from European Union or outside of the European Union now, people that are not already living in the UK. So we see that there is a shortage on the supply side in the labor market. There are increasing unfilled job vacancies. So this means that at one point, in order to find the good skills, some of the companies will need to increase a little bit the wages, but the potential is limited, as mentioned in the comment, because of the loss in profitability. So in any case, companies will suffer in terms of profitability and in terms of potential volumes that they could sell to export. The next question is about the BRICS, so Brazil, Russia, India, and China, and the fact that it will be difficult to bring them on board, and about the fact that probably the British government didn't really assess the difficulty of the task. The question is has the British government really the skills and the knowledge to implement this kind of negotiations and free trade agreements? Well, it's true that it is a new activity, and that the United Kingdom had to hire a lot of people on the export side. So a lot of jobs positions were opened, hundreds of jobs positions. These positions were filled by UK employees that were, for example, at the European Commission or other European institutions. But they have also called for help for skilled people in this area in countries like Australia or New Zealand, countries that have the experience of negotiating free trade agreements. So anyway, they are not alone. Australia officially said that they are ready to send more people if they need help with the negotiations, but definitely they still don't have the capacity to negotiate 50 plus free trade agreements at the same time. So this is why I was saying earlier that it will take time. So there will be let's say a priority list that will be built up by the government. But still, even if on this priority list, on top of the European Union, they have 5 other markets, it will be very complicated to secure all the free trade agreements by 2021, let's say. Yeah. Next question is about the tariffs on imports from the EU on different sectors. So we were discussing about until now the export tariffs. So basically tariffs that will be applied on imports by the EU from the UK. Yeah, so exports, UK exports. But there is also the other side, and it's true, the import side. And we know that the UK is very much dependent on the import side, so the question, it's a very fair question, what will happen on the import side, because also today they have 0 tariffs. It is a free trade also on the import side. So from what the UK government has announced until now, the purpose is to have the same WTO status as the European Union. So it means that at the WTO, the UK goes in order to take over the same European Union schedules, as we call them. It's basically applying the same conditions as the European Union to the rest of the world when it comes to imports. Why do they need to do that? It's because at the WTO they need to treat the nations in the same way. So if they apply a tariff to the European Union, they need to apply it to the United States, they need to apply it to China, etc. So it means that even if they would like to have a higher tariffs on the imports from the European Union, which anyway it's not in the interest of the UK because more than half of the imports comes from the European Union, it means that these higher import tariffs would also need to be applied to other markets. So it's not in their interest. So basically, on average, they will have the same import tariffs as the European Union. So it's not a change when it comes to imports from outside the EU, because anyway today they apply them. They apply it to the US, they apply it to China, because these are countries with whom we don't have yet a free trade agreement. The only change will be that indeed we will need to apply tariffs when it comes to the European Union, but these tariffs are around 2%, so they are relatively low. The next question. Where do we see the sterling exchange rate against the euro heading over the next 12 months? We didn't really change our forecast compared to the last webinar, where we were expecting a 5% depreciation in the sterling. So we continue to expect 5% depreciation, which should bring us to an exchange rate of around 112 at the end of the year, at the end of 2017. Then going further in 2018, we expect around the same magnitude in the depreciation, so 4 to 5%. So this should bring us around 105, 110 for the GBP euro. We'll still maintain the parity, so we will not go below parity until 2021. So basically we didn't change our view, where we say that even if we secure a free trade agreement in 2021, there is a risk to have just below parity sterling euro exchange rate. Obviously, if you don't secure a transition period and in 2019 we have no deal, then will already be below parity. Next question. What happens in a worst case scenario considering that no deal is reached between UK and the EU? How much money will UK have to move? Okay, with this we already touched upon this topic. When you talk about the free trade agreement, so basically the middle option of the slide, so the baseline scenario, the limited FTA, which you think it's most probable, is that a tariff on UK goods, services, exports? If so, we will be looking to contra that cost. Yeah. So basically, it's about the question on the balance between export and import tariffs. So it's true that in the limited free trade agreement scenario that we have, these are 2 to 3% on average. These are tariffs that will be applied by the European Union on UK exports, so on their imports from the UK. The costs on the services are additional costs, but the question is, can the UK counteract with the tariffs on the import side? And we discussed already earlier that it's complicated because there is a high dependency on the imports from the EU, first of all, and second, if they want to replicate and if they want to, let's say, to continue and to have an offensive, let's say, if they want to punish the European Union with higher import tariffs, then they will need to apply them to the other markets. So it will be difficult. What would be the impact on supply chains of the more extreme scenario? So basically the scenario of a no deal. It's true that the supply chains are very important for the UK because, as we know, a lot of the goods that are finalized in the UK actually come from other markets in the European Union, but also outside the European Union. So there could be a change, a drastic change, not only in the cost, but also in the time for production. Now the question, the most important one, would be, well, in terms of tariffs, regulations, but also in terms of will some of these companies want to move out of the UK? What will be the time that they will need in order to adapt to a new market? So there could be significant impact on the supply chain, but it's very hard to say how strong they will be. But they are already a little bit illustrated by the fact that we expect high, so severe export losses in the no-deal scenario. So we expect them to be around 30 billion sterling for the goods, where this compares basically with 12, yeah. So 30 against 12 in the baseline scenario, and 36 billion sterling for the services, which compares to around 14 in the baseline scenario. So already we can see that the impact will be very high. Next question, what difference will the new president and government in France make to Brexit attitudes and arrangements? Well, Macron is certainly it's certainly favorable to have a soft exit from of the UK from the European Union. But I would say that most of the European countries, if not all of them, even Germany, want a favorable deal with the UK. It's in the interest of nobody of having a tough stance, of too tough stance on the UK. So this is why we believe that in the end there will be the transition deal and there will be a progressive change in the trade agreements, relationships. So the impact will be much lower than if there will be a hard stance. So he has explicitly said that he wants to have favorable negotiations, and we believe that he will play an important role in the French-German couple, because there is a renewal, I would say, in this French-German couple. Now the only unknown variable is the next chancellor in Germany, but we will, at the end of September, we'll be able to know if the French-German couple will continue to be Macron and Merkel. The next question, and the last one, because we run out of time. So of course you will get a copy of the slides. They are actually available already on the platform, so you can go and download it. The last question is about the UK electorate and how skilled they are to understand the economic consequences of the Brexit. In my view, we are getting there because we have seen it in the recent vote. People went out to say that they don't want a hard Brexit; they want a soft stance. Even if this implies a softer stance on the immigration. So I think it was a moment of truth where everybody was able to see that actually after a couple of months where there was an impression of no negative impact of the Brexit vote, now people are starting to be more scared about their future financial situation because they see that there is already a negative impact. It's visible in their pockets. So I think we are getting there slowly, and people are getting more realistic about what Brexit means, despite the fact that nobody really explained them beforehand. So thank you for attending our webinar. I hope you find it useful. For the questions that I didn't answer now, because there are some that are still pending, I will come back to you today by email or at the latest tomorrow. Don't hesitate to ask questions by email still if you didn't do it through the platform. What can I say? Let's see how the future months are going through, and we will see how the negotiations that started very recently are going. So don't hesitate to connect to our next webinar on Brexit. Thank you.